My e.l.f. Beauty covered call is in the money, and I'm going to show you guys how I'm managing it today. Let's get into it. Okay, so here we have e.l.f. Beauty $90 call, and right now it's $7.60 for the contract. That means the contract times 100 shares, that's basically negative. It's basically it costs $760 for me to close it out today if I wanted to, minus the option premium that I received. Basically, it's negative $479. That's because the intrinsic value is negative 90, because if I were to close it out and then sell it today, the stock price is 96 bucks. So, right, it has that negative, like that intrinsic value of $600 basically, plus the time, which is where we get that negative 760 value, right? So my cost basis on e.l.f. Is about $70, 69.27. Okay. So now basically when I sold this covered call, the stock price was like maybe 75, 80 bucks. And basically, because I sold the covered call, I got all that appreciation, plus I got paid like 2.5%, 3% for the trade. Now, everybody's big question when selling a covered call is what do you actually do in this kind of situation? Now, there's still time left on my contract. Let's go back to the contract and we're going to assess based on the time. We have a $90 call, expires as of recording, it expires in about 11 days, 10 or 11 days. So there's still time. Now, I'm really actually willing to sell it at 90, even though the stock price is 96. But if it expires under, anything can happen in like 10, 11 days. So there's actually still enough time and it's not too far out of the money. I actually just want to wait in this situation personally, but it's going to be different for anybody else that might be in a different situation and depending what your goals are. Okay, so now let's just take a look at the option chain and we'll see what the options are if I were to roll the position to fix. Okay, so let's take a look, view all options. Okay, so if I were to, let's say sell call, let's just check here. We'll just manually check everything just so I can explain what's happening. So we have a $90 call that I sold. Right now, if I were to buy it to close, it would cost $695. And if I were to roll it, let's say a month out, let's say 39 days out to September 18th. This is one tool or tactic that we can use to fix a trade and basically give more theta, more time decay, possibly raise the strike price so that we could either capture more upside, get more premium, or both. Okay, so let's see. So if I were to roll it to 95 strike, right, which would capture $5 more of upside, this costs 740. And then to close my 90 strike that expires in 10 days, it would cost 695, 700 bucks, right? So I'll get a little bit of credit plus raise my upside by $5. Now, that works. I'm bullish on e.l.f. I think it's going to go a lot higher, but I actually want to free up a little bit of that capital so I can use that capital to sell more cash secured puts, maybe even get into other positions. I do have a big position in e.l.f. And then also the stock could go down. It could also go up more. So yeah, that's one option to roll. I'm personally leaning toward letting it go at 90. Yes. And one thing that helped me with my mindset now for actually letting go of covered calls is the fact that basically having another trade lined up in your head, something you want to do with that money. For me, I always kind of got married to the stock, married to, okay, I have to roll it because the stock is 95 and now it's my 90 is going to expire and I'm going to miss that upside, right? But I've also had a lot of instances where I roll it to, let's say, 95, and then the stock drops back to 80, for example. So I would have been in a better position even just selling the stock. So sometimes it's hard to account for the randomness of the stock market, but that's kind of where my head is going, is I'm trying to look at everything as a spectrum of possibilities, not just get laser focus on one outcome. So, for example, something that helps me to let go of the shares is to have a couple other trades in my head. Like, for example, with that 9K, I would get 9K back, and I would, of course, leave a little bit of upside potential um, on e.l.f, but that's okay because my average is actually 69 something. So basically getting a nice profit there. Now, one trade I'm looking at is looking at Robinhood. Where is it? Robinhood. So with that 9K, around this 90-ish, I would like to sell some cash secured puts around 90 bucks, and that would very cleanly recycle that money into a good trade, right? So if I were to sell a $90 put, cash secured put on Robinhood about 30 something days out, 39 days out, I would get 535. That's like a 6% return just off the top of my head. 85, if I were to even do an 85 strike, that would be 345. It's probably like a 4-ish% return, and it's about $10 cheaper than the current price. So that's a trade I'm looking at. Also, I'm looking at Netflix. Let's take a look here. 75. So if I were to do, I was kind of looking around the $70 strike, but let's just take a look at the option chain. So if I were to do at the money, 75 bucks, I would get paid 284. Yeah, 70, it's a little too conservative. If it was going to go down a little bit, maybe the stock drops, try to find a better entry there. Right around, yeah, 70, 72, that would be a great entry for me to start. Even 75, I mean, I'm bullish on it, but I just don't want to be too aggressive with it right now. Um, so yeah, having just some other trades lined up has really helped me with being able to let go of shares mentally. Also, it's a pretty outsized position. It's about, I think it's 17% of my portfolio, e.l.f. Beauty. So, and the stock is volatile. I rode this thing from like 140, 130 when I started acquiring shares to down to 49 bucks, back up, very bullish on e.l.f. But right around here, it's when I started buying. So my cost average was actually a lot higher. And then as the stock dropped, I did a pretty good job of actually just buying, dollar cost averaging, doubling down as it got lower, 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 when it get to 60s and 50s. As I kept doubling down, which is how it went up to about a 35K value. So total, I'm up uh, almost 10K, which is actually super nice because I was really down on the position. So that just shows you how, if you know what you're doing, you can just manage very well, and lower your cost basis on a good stock. Now, I don't care what anybody tells you about strategy, but if you're in a bad stock or a bad company, it doesn't matter the strategy. Everyone will sell you cash secured puts, covered calls, all this stuff, it's important. It's a good strategy for cash flow. But if you don't have a good company underlying, good stock, it doesn't matter. The strategy is gonna fail. So it all starts with the stock selection, and you have to have conviction in what you're in. So e.l.f. Beauty is one of those where I have a good conviction in. They're growing very well, and just very bullish on it. It is volatile, but with that volatility, you get a lot of good premium. So, one more thing, I just want to throw in a little Easter egg with Celsius. So Celsius, the stock dropped a bit. Stock dropped to about 24. Yeah, I think it dropped. Oh, that's one day. Yeah, it dropped to about 24. I actually bought 50 more shares at that 24 price. Trying to lower my average also on Celsius. Still very bullish on Celsius. There was a couple of crazy drama with like the CEO, the old founder of Rockstar Energy basically wants to boot the CEO out. I don't know. I like the CEO personally from everything I've seen. Uh, but yeah, so we'll see what happens there. But there seems to be a little bit of drama. Also, aluminum prices went up, so that pressed margin, the oil price, all the short-term stuff, short-term stuff. Also, I think their gap numbers got affected, by a one-time thing that there's kind of a misconstrued something there based on like the way they do their gap reporting. Basically, they had like a cost that they had to pay, but then Pepsi reimbursed them. Anyway, it's like there's kind of like a little bit of a messy short-term kind of picture, and I don't know, I like the brand. I think they're growing, very well. Drink company, they have a portfolio. They're very hung up on the Celsius flagship name, like, losing kinda growth or not growing as much. And then Alani Nu is growing like crazy. So they're I don't know, the whole company in general grew pretty good, but they're kind of obsessed with, like, the Celsius name versus Alani, and if anyway, so there's a little bit of mess, but I think the numbers are doing fine, and the brand is great, and I think they're running it pretty well, so we'll see what happens. But yeah, so I bought more, and I'm looking to probably sell some more, covered calls on that. Now, if I were to look at the option chain here, let's see here, we have 30. My cost basis is around 34-ish, so I'd probably look to get somewhere, probably around the 32.5, slightly under the cost basis, under the assumption that if it breaks that, then I would then, um, roll it above my cost basis. So I would have to fix the trade at some point if it went there and ballooned higher, but we'll see. It's pretty big jump from 26 to 32. I could also just do the 35 call, but I feel like the juice isn't quite worth the squeeze, only getting 21 bucks there. So we'll see if we get a short-term price movement or some good news. But yeah, I might look to do that 32.5, which is slightly under the cost basis, with the assumption that if we get this like big move, I would then roll it and fix the trade, worst case. So, all right, that's pretty much my thoughts currently on what I'm working with e.l.f. and Celsius. So yeah, that's pretty much it. We'll see you in the next video. Hope you got some value. Please like the video and subscribe if you enjoy this type of content, and we'll see you in the next one.